All right. Hey guys, thanks for jumping up on our podcast. This week, we have a fire episode for you guys. Two experts, two guys that I actually look up to when it comes to business. John Cornish and Chris Yausi. Go ahead, guys, introduce yourselves.
Yeah, super happy to be here. John Cornish with Key Mortgage Group. Thanks for the opportunity.
Chris Yausi, as you know, we've been doing the podcast for a couple of months now. And this week's episode, we've been talking a lot about cash flow and investment properties and paying down debt and how do you qualify and all these kinds of things. And John's going to tell just a little bit about his bio. I've known John for quite a long time. He's done a couple of projects. In fact, he's doing one for us in a local project we're developing right now. It's about 30 minutes from my location currently. So John, if you could tell just a little bit about your experience and specifically as it relates to investment properties and then we can kind of get into some questions.
Yeah, absolutely. So 23 years of experience in the mortgage business. I started out with Wells Fargo and actually was a full service lender. So everything from credit cards to personal loans, and I actually managed a portfolio. So dealt with collections, bad debt, and that was extremely valuable from a education standpoint of understanding the consumer, understanding credit, understanding debt to income ratio, and setting a budget and things like that. I've originated north of 4,500 loans. I am still originating on a daily basis, and I also coach a group of 20, 25 loan officers nationally, helping them basically learn what I've learned over 23 years, but burn their hand on the stove less than I have. So the idea is letting them learn from some of the mistakes that I have and what's taken me 23 years. Maybe I can help them do it in 5 years or a shorter time period. Extremely passionate about what I do. I'm not sure if the passion is really in the mortgage game or if it's definitely in the financial markets, but really enjoy working with people and enjoy having a business where I can push myself and help people with one of the biggest, if not the biggest investment that they're going to have. And I'm a true believer in the value of real estate, not only from a primary residence standpoint, but also from an investment standpoint of one of the most valuable and easiest ways to grow substantial wealth for both yourself and setting up your family. And I'm an investor as well. So I eat my own cooking, if that makes any sense.
Yeah, that's great, John. That's awesome. So before we get into pre-qualification, I wanted to kind of get rid of some of the negative stuff, and that is the reality check of what do you think is the number one mistake that borrowers make financially before they buy or want to invest in a rental property?
So I would tell you a lot of people use preconceived notions or things that they believe are truths that, that hinder them that aren't really there. So you have a lot of people that think you have to have a perfect credit score, think you have to be on your job for 5 years, or think you need 20 to 25% down. So they're setting limitations because of something that they've read, something that somebody without knowledge has told them that just isn't true. So when you're holding yourself back from making that investment because of information that's not accurate, that's probably the biggest mistake that I see people making. It's like, oh man, I wish I would have known about this sooner. Well, you got to reach out to somebody that actually has the knowledge. And also to kind of add to that, I'm not a big believer in regret because I think everything happens for a reason. But from a financial standpoint, one of the biggest regrets that I have is I spent too much money on renting a two-bedroom apartment to impress my wife now and girlfriend at the time and threw money away. And if I look back at if I would have taken the advice that I have now and bought a duplex and lived in it and lived in one of the sides and did that 3 or 4 times over instead of lighting $900 a month on fire to an apartment that built somebody else's wealth, I look at what that would have created and what that value would be now. And if I could go back in time, I would definitely change that, which is why I want to get this information out there because I can't change that for me, but I can change that for somebody else that's coming out of college and keep them from making that same mistake themselves.
Okay, excellent, John. I appreciate that. So, how important is experience when it comes to qualifying? Like experience in any kind of, you know what I mean, in the rental game? Because a lot of folks, it'll be their first time purchase and that kind of a thing. So, how
Listen, I don't
important is
think
that, or is that not that important?
I don't think it's that important. I
Okay.
think it's something that you can learn as you go. I think, listen, obviously you have to have an understanding of your budget. And I think it's important to, my advice would be if you're going to buy a duplex, a triplex, or more units, and the bigger it gets, the harder it is. But let's say we're going to start with a duplex. If I was doing it, I would say, okay, I want to make sure that if push came to shove, I could make this payment by myself. That way, if it takes longer to find a renter, we're setting ourselves up where we can succeed and not fail in case things don't work out the way that we want to. And I think as long as you have that financial backing set up, then you can learn everything else as you go. Because I think that's the best way that I've learned things is by getting my hands dirty and learning by failing. So I don't think you need a ton of experience. And I think in this day and age with technology and what's available on YouTube and AI, you can teach yourself everything that you need to know to build multiple units and create a substantial amount of wealth. So I wouldn't hold yourself back because you have no experience being a landlord. You get experience by becoming a landlord. And then you learn firsthand with real world experience. And I think that's way more valuable.
Yeah, that's a good point. I remember my wife and I, when we were we were first married, we bought 4 rental properties in a year. And I mean, like, it was like insane, right?
Yeah.
And they were just clunkers, just 32,000, 28,000, 36,000. This is in 1980, right? And I remember that I just loved the idea of owning real estate and renting real estate. And 2 of those 4 we actually lived in, you know, and we started out with the first one and then we moved over to the second one and so on. And we did that. We grew pretty fast in that in terms of doors. But the experience, I mean, dude, I remember the first time, one of my first buildings, I was like over there, like shoveling the sidewalk and shoveling the driveway for these tenants. I'm like,
Yep.
yeah, this is what I have to do this, And I'm like,
Yep.
pretty soon, I'm like, wait a minute, what am I doing this for?
Yeah.
And you learn quick, right? You learn
Yep.
quick, like, on the come, so to speak, where you have to really kind of just be quick, very pivot, rotate, and be able to kind of make those adjustments. But yeah, I mean, it's learning kind of on the fly to some point, unless you have somebody that can mentor you or teach you, or like you said, get on the YouTube or, get other channels and other advice from other fellow investors. So super
Yep.
important, though, super important. So let's start talking about pre-qualification. So what does the pre-qualification look like when it comes to investment property? How is that different? What are some things that you look at that a lender has to look at that you normally typically wouldn't look at if it was somebody that was going to actually live in the property?
Well, it's not that much different, to be honest with you. And there's actually two different ways, so you can buy an investment property and still live in one of the units, which is actually one of the hacks, in my opinion, of how to get started, because you can get in with as little as 3% down conventional, 3.5% down FHA. I actually have 2 of them that I closed in the month of September, where people that previously thought that they needed all this money to buy a duplex. And I said, listen, if you're going to live in one of the sides, you only need 3% down. That was a light bulb open moment for those people. So we always have to look at, obviously, your income, your credit, the assets for down payment with everything. The only thing that's really different about an investment property, and this almost makes it easier, you can use the future income of the other unit to offset the expenses from the approval standpoint. So you don't have to qualify for it on your own. If you can show with the comparable rent schedule that the other side will rent out for $800, you can use that as a calculation of getting underwritten and approved. So it makes it easier. There's also loans now, and they use the acronym DSCR, which stands for debt service coverage ratio. And that is we'll call it an alt-A product. So it's not a conforming product with the agencies. It's creating a lot of popularity, but that is basically where you're just approved on the debt service coverage ratio of the property. So you could literally have no income whatsoever. And as long as you can show that you're buying a rental property and the income from the rental property is going to cover the payments, you can get an approval on that. Now, the DSCR loans don't have as good of terms as the conventional, but it's an outlet where if somebody wants to get into the game, they can, if everything isn't super stable about their own personal life, or maybe they're self-employed and they can't show enough income because they haven't had it long enough. That debt service coverage ratio is another option for them. So again, The regular pre-approval, making sure we take a look at credit, making sure that we're actually looking at income and asset documents. So it's a valid pre-approval, because I don't want you going out and spending time making an offer on a home and I don't ask enough questions on the front end. And then we get to the actual process and you're not approved. So my pre-qualification process versus a average pre-approval or pre-qualification process is a lot different, because we dig a lot further, because I want to verify everything and make sure that it's actually there. But to answer your question, the biggest difference on an investment property is you can actually use those other units in the income that they're going to create to help you get approved for that property.
Okay, thanks, John. Let's dig a little bit deeper on two different things.
Yep.
The debt coverage service ratio, mainly what you're talking about is guys like me that do commercial lending. Is that what you're talking about? Or are you talking
No,
about this in the
I mean,
secondary market as well?
it's what we call a non-QM product, non-qualified mortgage. So it
Conforming,
doesn't,
yeah.
yeah, it doesn't have to follow the ATR, which stands for ability to repay. So it's a unique option, and basically the people that back these, the decision that they're making is on the investment property, not the income of the individual. Now the credit score needs to be there, but literally you could be somebody that, let's say that somebody had a W-2 job and they worked for 15 years, but they built their investment portfolio up where they say, you know what, I want to do this full time. I want to get out of my day job and I just want to build units and look into investment opportunities. They no longer have the W-2 income to support purchasing one of these properties. The property itself can approve them, if that makes any sense.
Yes. And then isn't it, I mean, maybe I'm outdated a little bit here, but in the secondary market, you're allowed to count, let's use your $800 a month, right? You're allowed to count 75% of that, correct?
Yep, you're exactly correct. And they use 25% is for possible vacancies. You're exactly correct.
Okay, so that's the number you're talking about when it comes to, you can count that as income. Now,
Yep.
do you literally have to have like leases in place to do that, or how
You
does that,
don't. You can have leases in place, or there's an appraisal that is done that basically, instead of appraising the property using comparable sales like you do if you're going to buy a home, it is a comparative rent schedule. So basically, we're confident enough in looking at the comparable rents that are out there that this property can rent for $1,000 per month. Use the 75% that you just mentioned, and therefore that $750 a month of rental income, which, let's say that buying this property puts you at a 50% debt to income ratio. Without that income of the 750 of the 75% of the rent of the other units will bring you below where you're qualified for this property.
right? And the debt, and what you just talked about, the debt to income, so people understand what that 50% is, if you could just touch that
Yeah.
real quick.
So debt to income ratio is basically the percentage of your gross debt income that goes towards debts that are reporting to the credit bureau. So current mortgage payments, car loan payments, student loan payments, credit card payments, and the future payments of the property that you're going to purchase. It doesn't take into consideration, your cell phone bill, your internet bill, gas card or gas and food and things like that. It's the ratios that reported on the credit bureau. And normally 50% is maximum. Depends on your credit score and other strengths. So basically you need to have half of your gross income that is still available, give or take, to get a loan approved. And on the investment properties, it's probably closer to 45, but there's definitely ways. Again, I'm closing on one this month, and I think they're at a 48% debt to income ratio with a strong credit score, to live in one side of the property, and they're going to rent the other one out.
Right. Okay. Excellent. So getting into the first time buyer mentality, let's separate that from somebody that actually owns a home already. So somebody that's already in an owner occupied property. Let's talk about those two separately. So getting into the game of investment property, like I just shared, Sandy and I, our first property was a duplex, and we lived downstairs and somebody lived upstairs. And then our second property was a duplex. We turned that into a single family, had an in-home business, and so on. So what's the advantage of doing that versus just trying to, say, get into a home and then maybe moving it, rinsing and repeating, say, a year, 2 years, whatever. And along with those lines, maybe getting too weedy here, but how many times are you allowed to do that under FHA? And how many times are you allowed to do that under conventional loans? In other words, the idea of, okay, I'm gonna buy an FHA, I'm gonna buy a property, I'm gonna finance it with FHA. I only need 3.5% down. I'm gonna live there for a year. but then I want to do it again. So
Yep.
just kind of talk a little bit about
Yeah,
some of those
I can.
things.
So the first one to touch on, I think it was, what's the benefit of having multiple doors is having one door. So what's the benefit of
Yes.
buying a duplex, living in one size, renting it out versus buying a single family residence and then moving out and renting it out and buying another one? The quick answer is there's more doors. And normally the more doors, the more profitable and also the more protected that you are. Because if you have one door with a property and it's vacant, you have zero. If you have a duplex and one side is open and the other side is rented, at least part of that is covered. So buying multiple families just allows you to accumulate more doors faster. Now, the question for FHA, so FHA allows for 3.5% down on an investment property as long as you're living inside, but FHA only wants you to have one loan at a time. So you
Okay.
can do that with FHA. Now, the guideline is if you're buying a home as your primary residency, that has to be your intention at the time. And normally I would tell you that you need to expect to live in that as your primary residency for at least 12 months, because it's going to be hard if you were to get audited or you were to get, the file gets pulled. You bought this house in July of 2025 and you said it's going to be your investment property and you moved out in October. What changed so quickly that you weren't being honest about that on the front end? And I'm not saying things can't come up, but you're going to have to explain yourself and you're going to have a very good reason why. When you get to the year time period, it's a little bit, there's less questions asked. So your intention has to be occupied the house or one of the units as your primary residency. And lying about that is mortgage fraud. And fraud is a real thing. And this is something that is looked for. And I actually have a transaction here recently that we had to say no to because we just had too many red flags that it didn't add up, because we need to protect ourselves and we also need to protect people from themselves. So it is not a good idea to lie to the government. If you want to do this, just follow the rules, move into the property, but you don't have to live there forever. So if you move into a duplex and then after 12 months, let's say you rent out or put a sign to rent out the other side and you rent that other side out, that would allow you to then go buy an additional property. Now, if you used FHA the first time, you would either have to refinance from an FHA loan into a conventional loan. So you now have your FHA to use one additional time. So you can refinance away from FHA. That FHA loan doesn't exist. Now, there are time periods where FHA will allow an exception to having more than one loan. And you have to prove that basically your family, you have to move within a certain distance. I believe it is 100 miles away from the property. Don't quote me on that exactly. But you have to prove that your family size is increased and you have to buy another home. And FHA is the only way that you can buy it. So you and your wife move into your first duplex. You use FHA financing. It's 600 square foot on one size with one bedroom. You have a kid, and now you're saying this house doesn't work for me. FHA will allow you to go buy another property as long as it has an additional bedroom and additional square foot. And you can explain to them that, hey, listen, I need the second FHA property because it meets the size of my family. That can only be done a second time. So you can't do that a third time. That will allow you to have a second loan, not having a third loan. Does that make sense?
Yes, absolutely.
That's
Before we get into the conventional part of that, because I want to talk about that, because then the second loan will have to be conventional. So what about VA though? VA has a certain level, the DD 214 form for VA for
yep,
our veterans that they get.
yep.
That has a certain number, correct? Like
It
there's
is.
a dollar
It's an
amount in there.
entitlement amount, and there's a lot of misconceptions about VA loans. I hear it all the time. Some people think you can only have one VA loan your entire life. So I've talked to a veteran and said, "Oh, we don't want to use it on this house. We want to save it for our next house." I'm like, "What are you talking about?" So you can have multiple VA loans, and you can actually have multiple VA loans at the same time. You just have to have enough entitlement to cover the VA loan. And sometimes that means it's a calculation that they use. And sometimes that means if the first one was 100% financing, you can go buy a second VA loan, but the calculation may say that you need 3% down or 6.5% down. It is a graph that we use or chart that we use that tells you exactly what we need. There's also a purchase price that I still believe is $144,000, and that's what's called bonus entitlement. So you have your regular entitlement, and if you buy a home above 144,000, there's bonus entitlement that makes it easier for you to buy a second home. So I think in a situation like this, could you have more than one duplex using VA financing? You absolutely could. could you potentially, and you could get to more than that as well, as long as that calculation works itself out. The larger the loan amount is, the more of the entitlement that you're going to be using for that first loan.
Right. For example, ironically that we're talking about this, but we just signed a contract on a spec home that $1,125,000 VA loan.
Yep.
It's a
Yep. There
VA
used
loan.
to be there used to be a conforming limit,
Yeah.
that was one of the things. I believe it was Trump, his first term. I believe he was the president that got rid of that. So
Right.
it was hard to get a VA loan, or you had to have more of a down payment was when it was above the conforming loan limit or jumbo. But yeah, you can do VA loans. You can do large VA loans.
Right. Well, think
Absolutely.
about it. I mean, the coast, like California and Florida and some of the
100%.
crazy pricing,
Yeah.
you have to have more than,
You
more than
do, and you
we do
also
in
have
our market.
veterans that have served. And sorry to interrupt you, Chris. You also have veterans that have served for a considerable amount of time, that have built up an extreme amount of wealth and income, because let's say they have 20 years in active service, and then they get a very good pension and sometimes disability, which they've earned. And then a lot of times these individuals can go out and get a full-time job in the private sector, and they have both of those incomes. So they can easily support a loan amount that is above the conforming loan limit, especially when you're talking about the areas where, there's areas at the average price point of a home, it's hard to buy a home for less than $800,000. Obviously, in the Midwest, we have a lot more affordable housing, but you're 100% correct there.
So along those lines, then I'm just trying to, kind of come up with some scenarios here. So feasibly, somebody could get a VA loan to start out with.
Did you say VA or FHA loan, Chris? I didn't understand.
Either one, let's
Yep.
just do either way. They could do a VA loan to start out with. They're living in it. They stay there a year, 2 years, whatever. They decide, you know what? I've outgrown it. I want to use this as a rental property. Now I'm going to do an FHA loan and I'm going to live in it. They could do both of those loans as a veteran and still get in with minimal or no money down. Is that
100%
accurate?
correct. Yep.
Yeah.
You would normally only use FHA financing if you can't qualify for VA, because they're both backed by government agencies. VA, that kind of the saying that I always use is VA is an FHA loan on steroids that's just for the veterans to reward them for the service that they've made to our country. So
Right.
no down payment as opposed to 3.5% down payment. And also they don't have any of the monthly PMI, which makes the savings much more affordable. But yes, you could do either of those options.
Right. And then the FHA also has a program for repairs that can be used as well. Why don't
Yep.
you share a little bit about the name of
Yep.
that program and what that
It's a 203K. It's a renovation loan. So basically it allows you can actually do it as a purchase, or you can do it as a refinance. So if it's a purchase, you buy a duplex, let's say the duplex one again, and let's say that the duplex doesn't meet the FHA guidelines as far as the condition of the home, because FHA is more picky to protect the consumer. So it can't have, and I'm not going to go over everything, but it can't have like chipping and peeling paint when it's over a certain amount old for lead-based paint. Can't have cracking windows. The roof has to be in good working order. It can't have exposed wires. So if you find one of those properties and it isn't meeting the FHA criteria, what this renovation purchase loan will allow you to do is go out and get bids from a contractor to get the property up to the condition of the FHA, purchase the home, and then do the renovations after you buy the home. So it is a great program that can allow you to do that. And it doesn't have to just be done on multifamilies. We're kind of focusing on that. It's something you could use on a regular house. Or let's say that let's use a different example. So let's say that the house does meet FHA standards. You just want it updated. So let's say one of the sides you're fine with because you're going to be renting it out, but the other side is a little bit in worse condition. And if you're going to live in it, you want an updated kitchen for your family and an updated bathroom. Even if it meets FHA criteria, you can use that renovation project to basically finance that portion in. So you don't have to put the money down and then pay for the renovations out of pocket. You can actually borrow the money. And what they use is they lend off the future value of the home of when it's done. So if it's worth $200,000 now, but it's going to be worth $250,000 when the renovations are used, we use the valuation of the future value with the improvements on that product.
Right.
And believe it or not, VA actually has a similar product as well. Less places have it. It's more challenging to get done, but it's a very similar product. It's just for veterans, obviously.
Right. Yeah. And I remember I don't know, maybe 15 years ago or so, I actually did one of these loans in terms of I was the contractor who went in and did the
Yep,
work. And it was the same thing. It was that FHA,
yep,
basically that extra mortgage. And I had to have the bids and I had to be
yep,
qualified, had to meet the
yep,
criteria that FHA required,
yep.
all these different things. It was a great program for me. And the buyer was just ecstatic because they got all these new things, in the house.
Yeah, absolutely. In addition to a purchase, you can do it for a refinance, and a lot of people did that. So let's say, like many people, let's say you bought a house in 2020 or 2021 when interest rates were free. We're going to call them that. They were in the twos, and you're looking at it, and you want something different. You want something that's bigger. You want something that's updated. But when you look at the cost of purchasing a new home because of what the value of real estate has done, and the increased cost of where interest rates are at today, people decide, you know what, I want to fix up the home that I'm in. So you can actually do it as a refinance as well, where instead of having to pay for those renovations out of pocket, you can do renovations on a home that you currently own to do a brand new kitchen, do a home addition, put a garage on, and that can be done for both FHA and actually Fannie Mae has a conventional product as well.
Yeah, it's a great program. So we're into the buyer and kind of ahead of the buyer, right? And the
Yep.
investor who wants to kind of go into his next phase, right? And he owns one, wants to do two, and wants to go to another one. And for whatever reason, he can't pull off the FHA or the VA, so he has to go into conventional. And talk a little bit about conventional and what that looks like from an investor perspective in terms of equity needed and things like that.
Is this for are you going to be
Live-in.
living in
It
one
could
of
be
the
a live-in
sides?
owner. It could be another live-in owner. Yes. And
If you're living in it, again, it's minimum down payment, 3 to 5% down. If you're going to be living in one of the units as your primary residence. If you're not going to be living in one of the units, so if you just want to go buy an investment property that you're not going to live in, and it could be a duplex, but you're going to rent out both sides, 20% is required if it's a single family. If it's a multiple family, it's going to be at least 25%. So it's
that's
a
one
much
to I'm sorry, John. That's one when you say if it's a multifamily, that's 1 to 4 families, correct?
You're exactly correct. 1 to 4 families can be done through the secondary market. Anything larger than four, basically you're looking at either a portfolio product with a bank or it's a business at that point. So it's
Right.
going to be regular, a 5-year balloon.
Right.
You're not going to get the agency fixed money.
Right.
Again, if you're living in one side, you can be as little as 3 or 5% down for conventional. If you're not going to be occupying the property, 20% down for a single family residency. Multiple families requires at least 25% down.
Okay. So let's say that you have a young couple, right? They're 25 years old, they're 28 years old, and they don't have any children yet. They don't have any really obligations that way, as far as a family, but they really want to get in the game. How often can they kind of rinse and repeat this? Like, do they have to live in a unit for a certain period of time, or could they do this a third time and a fourth time and a fifth time? At
You can
what
do it
point?
multiple times. And again, that 1 year time period is probably what I would advise because you're
Right.
signing something
Of
at
course.
closing that is saying that it's your intention is to occupy it as your primary residency. But again, I had an investor earlier on this year who bought 3 properties within like 45 days and he wasn't living in any of them. So that you can do it really as quickly as you want to until you get the maximum number of properties financed. And really the only thing that slows people down at that time period is coming up with the down payment, right?
And that's the 20% down requirement you're talking
Yep,
about.
you're
But as
exactly
far
correct.
as somebody that's living there, are they limited to how many times they can do that in the secondary market? And again,
No, you could do it
talk
as, I
about the
mean, you can get to the 10% maximum financed homes and you can do that whether it's primary or it's just rental. So that doesn't really change anything.
10% maximize. Say that again.
Number of 10 units financed is
10
the
units.
max you
Right.
can get with the agencies.
Right.
So, but you can get there, and all of those could be homes that you lived in over a 10-year time period, or you could have 2 houses that you lived in, you build up some wealth, and now you can put 20% down and you can go. So once you get to that 10%, that's when you have to go outside of Fannie Mae and Freddie Mac. And again, then you're looking at more at, regular bank financing,
When you
looking at
said,
it as a business.
okay, you mean 10 units, not 10%, right?
Yeah, I apologize. I made misspoke. I meant 10 units financed, not
Right.
10%.
Right. Okay. So the 10 units then, John, I think there's a big misconception out there because a lot of lenders if you talk to lenders, and I know this, and obviously you do as well, they'll tell you, oh, you can only finance five. And then you got to go to the second, then you got to go get, basically commercial money, which
Commercial
is 2-year
financing.
money, 5-year money versus fixed rate financing right now, 6.5%, 6.75%, wherever it's bouncing around right now. But you can only get five of those. And you're saying 10, which I'm in agreement. I'm on your side.
Yep.
Explain the difference between some lenders saying five and some lenders saying 10.
Okay, and this can be used in multiple scenarios. So you have the agencies that sit on top of conventional financing, which is Fannie Mae and Freddie Mac. And let's look at Fannie Mae and Freddie Mac as Ford and Chevy, right? They do the same thing. Ford and Chevy both build trucks, but they have a little bit of different nuances. Fannie Mae and Freddie Mac are on the top of everybody. They make the rules that everybody has to follow, regardless. Now, below Fannie Mae and Freddie Mac are all your servicers and your banks. So you have your Wells Fargo, you have your Chase, you have your US Bank, you have your PennyMac, you have your Mr. Cooper, AmeriHome. There's like 40 that we deal with. All of those lenders have the ability, if they want to add what are called overlays, because they're the ones that are lending the money. So if Fannie Mae and Freddie Mac, let's say that they have four rules, everybody has to follow four rules, but all of those additional investors below that, if they want to add one additional rule, three additional rules, five additional rules, they have the ability to do that. So they can add additional rules because they're the ones that's taking the risk and servicing that money, but they always have to follow the rules of Fannie Mae and Freddie Mac. So that can come as the amount of properties financed. That can come with credit scores. That can come with debt to income ratio. Like, so for example, there's lenders that, and we work with multiple lenders, with the business that I have being a independent mortgage banker. So I have lenders that have overlays that say, okay, your maximum debt to income ratio is 45%, or you can only have 5 units financed. And I also have lenders that follow the agency direct, and we follow agency direct. So if the agency will allow me to go to 49%, I can do that. If they allow me to go to 10 units financed, I can do that. It's the lenders that are adding additional risk for their paper or additional rules for that. And there's nothing wrong with that. That's their right to do. What people don't realize is when somebody's lending you, north of $500,000, they have the right to make the rules, and they can make more rules than Fannie Mae and Freddie Mac, because they can also then come back and say, okay, my paper is more valuable because not only do I have the rules of Fannie Mae and Freddie Mac, I'm even more protective because I max out debt to income ratio at 40% or 45, or I only allow for 5 units financed. And then they can sell that commodity at a higher price point because they feel like it's safer. Or maybe that's just their bank regulations and normally the bigger that you get, the more regulators are on you. So like when you're chasing Wells Fargo, you got a ginormous, Citibank, you got a huge target on your back. They're looking at everything. They love suing you and getting your money. They're always going to be a little bit more cautious because they can be. And then some of these other smaller servicers that aren't that large and they're trying to grow, they can be more aggressive to go after the business that Wells Fargo and Chase doesn't necessarily want. So I didn't mean to get too long-winded, but
No,
basically,
no, no. It's important that people understand that there's differences in lenders, and it's important that they understand if do you have basically the bottom line is the question a buyer should be asking if they want to really get aggressive and get more than, a couple of units. I want to go up to 10 and say, hey, do you have overlays? If lender
correct,
says, what are you talking about? Well, guess what? Dismissed. Time to go on to the next lender. Do you use
100%. And
overlay?
there's
Really
some
simple.
lenders that won't even know that the
Exactly.
answer to that question. They
Exactly.
don't even know what overlays are.
It's
But you're
interesting.
100% correct.
It's interesting to your point about Chase. Let's pick on Chase. Okay. We had a deal that somebody's trying to buy a condo, and Chase, they're mouthing off about how, oh, I can get you approval in a week. Okay, whatever, right? So we're 30 days into it. Oh, they need this. Oh, they need that. Oh, they need more. And it's just going on. And finally, I said, okay, here's the deal. There's no more extensions. We're done.
Yep.
The only way I'm giving an extension, you got to use my preferred number, my preferred lender, which is Steve.
Yep.
And I said, that's it. Yeah, you've got X amount of days. So over the weekend, they thought about it and they said, you know what? We're not waiting. Who's Steve? What's going on? How do we call Steve?
Yep.
Steve's got the con and he'll get it closed.
Yep.
So it's critical that you basically have to choose. not just the right product, but you have to have the lender that understands all their intricacies, which is what, kind of what we're talking about, this morning,
Yeah.
So,
Something to add on to
yeah,
that, Chris, that's actually valuable, and I've had this conversation, is we can sell a loan to Chase or Wells Fargo and do it ourselves and originate it that Chase and Wells Fargo can't do. So I've literally had turn downs. Like I've gotten known of getting difficult deals done. Chase will say no to a deal. We get the deal done and sell it to Chase. And the reason for that is when we originate the loan, we take on some of that risk. They're saying, okay, we're going to buy it from you. But if they audit it and they don't like what they see, they can push it back to us. If they have any early payment default, which is payments that are missed in the first 6 months, it goes back to us. So when they buy a loan from us, Chase or Wells Fargo, we have skin in the game. When they originate it from soup to nuts, from start to finish, there's no one else to push it on, if that makes any sense. So not only
right.
does another lender get it done, another lender can actually get it done. And if you want to be with Chase, we can get loans done with Chase and sell them to that Chase doesn't have the ability to do it themselves. And that's not a dig on Chase or Wells Fargo. They're great banks. They are. It's just that no one is usually everything for everyone, right?
Yeah,
So you got to figure out what is it that you're trying to accomplish,
right.
and can they actually get to the finish line? And more importantly, when you're sometimes these things happen during the process of just realizing you got to trust the people that are helping you and take the advice of going, okay, it's time to cut bait and move on and go to some place that can get this to the finish line for all of us.
Exactly. All right, let's talk about now. Let's move in a different direction. Let's talk about the person who they're owner occupied. They've lived in their home for 10 years, 15 years, 5 years. They want to buy their first investment property and they're not going to live in it. They love their home. They just want to buy an investment property. So then we get into the 20% game, right? So let's talk about like a HELOC, like that one way to get some equity, right? They've got
Yep.
some equity in their home.
Yeah. So
Point.
the example you talked about, somebody that's lived in their house, 5, 10, 15 years, and let's say that they have $200,000 in equity in their house. You can use the equity in your home to come up with the down payment on the investment property. So you could technically get into that house for no money out of pocket. So equity in your home is a trapped asset unless you sell it or you borrow against it. In this situation, the customer doesn't want to sell that asset in order to tap into the equity. So you can do two things. You can do a home equity line of credit, which is basically you keep your current first mortgage. So if you bought a house at $400,000 and you put, 30% down, the balance started off at 280. Let's say you paid it down to 260. You now have the equity difference in between 260 and $400,000. That is an asset. The banks will normally very easily lend you up to 80% of that value. So they would loan you $320,000 and you would be able to borrow the difference of those two. So if the first mortgage balance is 260, you could access that additional $60,000 out of the equity of your home, and you could use that to put money down on an investment property. What I've had other people do is they do like multiple collateral lending, or they do where they use multiple properties. So let's say they do this over and over again, and now they have 5 different investment properties and their primary, and all of them have some equity in there. Sometimes banks will take multiple of those properties as collateral and give you a line of credit that's using all of those, to where you can actually go out and not only have a down payment, but then you can go out and potentially pay cash for a home that is dilapidated, where you can't get regular financing, buy a foreclosure, a home. And in this game long enough, people are like, oh, how can I finance a foreclosure? Listen, the good deals, the people with cash are going to beat you to the punch. They just are, right? So if you have that cash, you're in the driver's seat, because you can say, hey, listen, I want to buy this house. I can close in 3 days. I don't need financing. I have the cash to do that. And a lot of times people use these lines of credit to utilize the assets they have in all of these properties, because there's not a lot of people that are sitting on $150,000, $200,000 in cash. And there are those people, but there's a lot more people that have that built up in real estate equity, because it's, again, we've talked about the whole basis behind this. It's one of the quickest, easiest, and safest ways to grow wealth.
Amen. Amen. Yeah, that's a great analogy and just kind of a great explanation. And HELOC, for our listeners and viewers, HELOC means home equity line of credit. And John, when you let's just say you're going to finance an opportunity like this, where somebody comes to you and say, hey, here's what I got, here's what I want to do. Do you guys get involved with HELOCs then, and you somehow put a second mortgage, or do you just refinance the whole thing, or how does that work?
It depends on the situation. And what I'll tell you also, a lot of times these things don't come up because the customer asks. They come up because we run into a hurdle and then I provide a solution. So it's not very often. I mean, sometimes people will have the knowledge to ask for that. But what happens a lot is somebody says, hey, John, I want to buy, I've been, researching investment properties. I've been interested for a long period of time. I want to get involved with it. And I say, okay, that's great. Let's have a conversation. And then I drop the bomb on them that they need 25% down to buy a fourplex. It's like, oh man, I don't have that cash. It's like, okay, you don't. But then I look at their profile and go, hey, listen, what you do have is you have the equity in your home. So I lead them down that road of saying, hey, here's how we can solve the problem and get you into the home. Now, when we compare a home equity line of credit to doing a cash out refinance, and a cash out refinance is if you own the same example, you own $260,000 on a house that has access to 320, you pay off the first mortgage and do a whole new first mortgage where you don't have a first mortgage and a home equity line of credit. Now, when we do that, it's really just based on the average weighted interest cost. So I've had a ton of people in the last 12 to 18 months that have called that need money for, not as often over the last couple of years, for investment properties, but let's say they need to consolidate debt. They need to tap into that equity. If their first mortgage is locked in at 2.875% and the going cash out refinance mortgage is 7%, and they owe, $200,000, they're only taking out $30,000, we're not going to increase the interest rate of 2.875 to 7% just to get $30,000 of new money. So that's the one where my advice would be, we're going to leave the first mortgage alone and we're going to go to the home equity line of credit. Now, technically, I do have access to home equity lines of credit through the wholesale channel, but I don't do it that way. I refer them to a banker that I use. And the reason for that is I've always said, when I do what's best for the customer long term, that actually grows my business more. And home equity lines of credit are just not competitive on the secondary wholesale market.
Yeah.
The banks own that. So again, why do I want to charge one of my customers, an example, charge them $750 more for me to make $300? To me, it doesn't seem like the right thing when I know I can refer them to a banker of mine that can give them a better product and do what's better for them. And I don't need to make money on everything, right? You take care of the customer, you fulfill that need, you create that trust. Sometimes we make revenue off of people, other times we don't. But when you focus on helping people, and for me at least in the long run, it's worked out. So getting a little bit long-winded, but basically you look at their financial picture and find out, is it better to do a cash out refinance or is it better to do a home equity line of credit? And when we do a home equity line of credit, I refer them to a banker that does, and I probably have in between 5 and 15 of those going on with referrals that I've sent over to that banker at all times because they happen on a regular basis. The same thing with bridge loans or certain types of construction loans that we can't do or we don't specialize in. If I'm working with a builder and I know there's an easier way to get to the finish line by referring it off to a banker to do a bank construction loan, I'm doing that all day long because it's easier for the builder, it's easier for the consumer. And again, when you do what's right for people, I've just experienced it usually in the bigger picture, it ends up being rewarding for your business as well.
Amen. Amen. Okay. We've got just a few minutes, I think 3-4 minutes left. Before we close, I'd like you to answer this question, John. What do you think is the biggest obstacle in terms of an investor trying to get into this game? And 2, the better question is, what excites you most about being an investor? Because obviously you're an investor, you've got rental properties yourself. So I'd like you to hit both those things. The biggest challenge, maybe kind of getting started, I don't know, whatever that is. And then also, what do you think, what excites you the most about being an investor in the real estate game?
So the biggest challenge is normally the down payment. That's what slows people down the most. And that is the discipline of holding off instant gratification to build something that you need, right? So you can't, if you want to go out and maximize your debt to income ratio, and again, use the example of living in a fancy apartment to impress somebody, and I wasn't doing it at that time for that reason. It's just what I thought was normal. I'm going to be living with a girl. I lived in very bad places when I was a single college guy, right? You have to make the sacrifice of saying, okay, I can't buy this super fancy house and go buy all these super fancy cars and utilize all my debt to income ratio, and then also have the ability to save up money to create wealth. Sometimes you have to pick and choose, and you have to make short-term sacrifices in order to create long-term gain, right? Because you have to save up for down payment. So the saving up for down payment is a thing that slows people down the most. And that's because, unfortunately, we have a society, and it's not everybody, but they want instant gratification. They want to keep up with the Joneses. So people don't want to buy a used vehicle with a very low monthly payment. They want something new and fancy. They don't want to buy an affordable home. They want to buy something really fancy, and that doesn't give them the disposable income to save up for that down payment on the investment property. And you could have your entire life go by where you're chasing these things that you think make you happy that actually keep you from really creating wealth. And right. And so you have to change that mindset of you have to find a way to either earn more money or tighten up your debt to income ratio and your budget so you can save the money to then start creating this wealth. Now, there's shortcuts like we talked about. There's the hack of buying one of your own side. But again, there's still sacrifices that are made there because, right, it's not as nice as a fancy single family residence. So, okay, I'm going to be more conservative and I'm going to buy a duplex. So it is looking at, I'm going to give up some of the things that I want right now in order to get to the things that I want long term and take those sacrifices. You can say the same thing about dieting and exercise, right? Like everybody wants to eat the cheesecake, right? Or the double cheeseburger, and they don't want to exercise, but you don't get the good benefits unless you make those sacrifices.
Right.
Money's
Right.
the exact same way. So that's the
Right.
thing that holds people back. And the people that are good at it, they're disciplined and they're smart with their money, and they look at money differently than what regular people do, right? And you've seen people on all the podcasts about creating wealth and keeping things as lean as possible so they can do that. So that's the part that holds people back. The part that excites me about real estate, and I'm just going to say real estate overall, and then I'll talk about as an investor. What else can you buy that is normally more affordable when you compare apples to apples than renting, that you can create memories with your family, give yourself a safe place to live, have a lot of joy, and also create wealth? So that's real estate overall, right? You compare that to a 401k. You can't live at a 401k. You can't host your daughter's or your son's birthday party at a 401k. You can't have your family over for Christmas or Thanksgiving and have memories at a 401k. It's an investment, but you don't get to enjoy it while you're doing it, right? So that's real estate overall. Real estate from an investment standpoint of owning apartment buildings and owning multiple rental properties, the thing that excites me is that I believe that it is safe because people always need a place to live. You can control your outcome a lot more than you can with a stock, right? You can do the research of the neighborhood, the values, the things that are going on in that property. And the thing that is wonderful, when you get it built up, you have what I call mailbox money. So it is money that you're making while you're sleeping or while you're doing your day job. In my day job, I have learned that through discipline and hard work, I've been able to learn how to make an income that is above average that I'm very proud of. But that is directly through hard work. There are no shortcuts. When you then use your income that you create to buy assets that can literally make you money and multiply while you're not doing anything is, to me, the really part that is rewarding. And again, I can also see it, right? It's something tangible that you can drive by and you can see, different than a stock. And I'm not down on stocks. I have a lot in the stock market as well, but I think you need to be diversified. And I can tell you what's performed the best. It has been real estate. And also I think it's the safest because, again, I think it's protected. And as long as you don't get over leveraged and you don't get greedy, most people do really, really well over the long run. So that is the part that excites me about it, is the overall value of real estate. And I think it brings families closer when you have a home and you have a good, that was one of the first things I wanted for my family, was a good home to raise a family. And then you can do that over and over and over again, and create this wealth that you don't have to actively work for. And that can go well on into retirement, where I can spend time with my kids and my grandkids and have this money that continues to come in that is continually building in value, because real estate only long term only goes one direction, and that's up. And we have had time periods real estate values have gone down, and you hear about those 08 and 09 crashes. They're abnormal, and that was because of manipulation and incorrect things that happened and people over leveraging. So
Okay.
does
All
that answer
right.
that
Great.
question for you, Chris?
Yeah, yeah. That's getting after it. I mean, it's one thing for me to get up here and yak about it, but it's another thing for somebody that's, an investor that we know pretty well and has done well with it as well. So it's like it's always good to get a different point of view and a different perspective, especially for somebody that has a financial expertise like yourself. So we really appreciate John coming on today and really helping some of our listeners and our viewers understand some of the fundamentals. And well, maybe we'll have you on again another time when we get into some more weedy stuff and some more heady things that we can kind of do some advanced training and teaching on. And it's just great to have a fellow investor on here who understands basically the game that we're in. I love the
Yeah.
real estate game. It's done very well for me and my family, like you were talking about. And it's just just an incredible blessing to be a part of it. So we thank you for listening today, and we'll see you next week.
Thanks,
Perfect.
John.
Appreciate the opportunity. Thanks, you guys.
Thanks, Chris.